Hey everyone, welcome back to Corporate Dakota. If you thought business deals were straightforward, you might be surprised by what hides in plain sight. Today we're diving into a recent filing from CareCloud Inc. This isn't their regular check-in, it's more of a look what we just did announcement. And what they've done is make a pretty significant purchase, a business deal that could reshape their future. So CareCloud, if you haven't heard of them, they're in the healthcare technology space. Think software and services that help hospitals and clinics run smoother. Now they've gone and bought a chunk of a company called MedSphere Systems Corporation. It's not small change either. They're shelling out a total of $16.5 million for this. This deal is structured in a couple of interesting ways. They paid $8.25 million in cash up front. But the other half, that $8.25 million, isn't being paid directly to MedSphere. Instead, it's going to Wells Fargo, their secured bank lender. This part is being paid over time with a hefty 12% annual interest rate, and it's due by February 2026. And get this, CareCloud and its subsidiaries are on the hook for this deferred payment. They've even put up their own assets as collateral to secure this loan with Wells Fargo. This means if CareCloud can't make the payments, Wells Fargo has a claim on their stuff. Now, about the actual purchase agreement itself, it's packed with those typical promises sellers make about the condition of their business called representations and warranties. But here's the twist. CareCloud has insurance to cover them if the seller messes up those promises. That's a smart move. However, they also say CareCloud can't go after the seller for most of these issues unless it's outright fraud or a deliberate lie. They also have limited rights to get money back if the seller breaks their promises about how they'll cooperate moving forward. To help with the handover, MedSphere is going to provide what's called a transition services agreement. Think of it as MedSphere acting like a temporary consultant for CareCloud, showing them the ropes on things like getting the IT systems working, customer support, and basic operations. This is pretty standard in these kinds of deals to ensure nothing breaks during the changeover. So to put it simply, CareCloud has officially bought the assets and taken on some of the responsibilities from MedSphere. This filing is basically their official announcement that the deal is done. And as we mentioned, this deal creates a significant financial obligation for CareCloud. That deferred payment to Wells Fargo is a big one, and it's backed by their own company assets. It seems like CareCloud wanted the world to know about this deal pretty quickly because they also put out a press release a few days after the deal closed on August 25th. Now the filing also tells us what's coming next. They promise to file the detailed financial pictures of the business they just bought and also some projected financial information, but they're not giving us those details right away. They're going to file them later. This is pretty typical for these types of announcements. And what's really interesting here is the sheer number of supporting documents connected to this deal. We're seeing agreements for the asset purchase, the transition services, the security arrangements with Wells Fargo for different types of assets like patents, copyrights, and trademarks, and that crucial deferred payment agreement. The report is signed off by Norman Roth, who holds a couple of important roles, Interim Chief Financial Officer and Corporate Controller. This shows the seriousness and the financial weight of this acquisition being managed at a high level. So let's talk about what this all means. CareCloud is making a bold move by acquiring these healthcare IT assets. The $16.5 million price tag is significant, and it shows they believe this business unit from MedSphere is worth it potentially to boost their long-term revenue. Investing $16.5 million for revenue that approximates the purchase price implies they expect this acquisition to pay for itself over time. However, the financing structure with that 12% deferred payment and the collateralization of their assets is a key point to watch. High interest rates can eat into profits, and if the acquired business doesn't perform as expected, or if CareCloud faces other financial headwinds, those secured assets could be at risk. It's a classic case of using leverage to grow, but leverage always comes with its own set of risks. We need to see how well CareCloud can integrate these new assets and transition the services from MedSphere. The success of the transition services agreement will be crucial in the early stages. If they can smoothly absorb the new operations and customers, a significant portion of the acquisition's value will be realized. Looking at the company's structure, common stock and preferred stock are registered on the Nasdaq Global Market under symbols CCLD and CCLDO respectively. This suggests they are a publicly traded company with investors keeping a close eye on their performance and strategic decisions like this acquisition. Overall, CareCloud seems to be pursuing a growth strategy through acquisition. The healthcare IT market is competitive and growing, so picking up a business that complements their existing services makes strategic sense. The key will be execution, effective integration, and managing the financial commitments. They're betting on this new business to contribute positively to their bottom line and strengthen their position in the market. This is a calculated risk, and its success will depend on how well they manage the post-acquisition phase. So what's my take on all this? CareCloud is clearly trying to expand its footprint and revenue streams. The acquisition itself is a positive sign of ambition. However, investors should be wary of the financing. That 12% interest rate is quite high, and it puts a lot of pressure on the acquired business to perform from day one to cover those costs. If the integration isn't smooth, or if the market turns, this could become a burden rather than a booster. They've put their faith in future earnings to cover a present debt with a rather steep price tag. The next few filings will be critical to see if this gamble is paying off. So what's your take on this CareCloud deal? Does the acquisition seem like a smart move, or is the debt financing a red flag? Let me know your thoughts in the comments below. If you found this breakdown useful, please give it a thumbs up and subscribe for more in-depth looks into the world of corporate finance. And don't forget to join our Discord community for more discussions and exclusive content. Make sure to check the description. Thanks for watching, and I'll see you in the next video.